Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
So today we're diving into some interesting moves by the Canada Mortgage and Housing Corporation, or CMHC, as they aim to restore housing affordability standards to pre-pandemic levels. This is quite the shift from the earlier reliance on benchmarks from the early 2000s, which the Bank of Montreal has criticized for being outdated given today's market dynamics.
Yes, Steve, and it's clear why this shift is happening. The early 2000s were a different time for housing in Canada, with cheaper prices and fewer constraints on supply. But today, even with a 20% increase in housing completions since 2019, affordability has actually worsened because demand is still outstripping supply.
Exactly, Janine. The Bank of Montreal points out that negative real interest rates and rapid population growth, which has peaked at about 1.3 million people annually, are driving this demand. They believe that by addressing these issues, we can potentially reach pre-pandemic affordability levels with stable home prices, modest borrowing cost reductions, and a consistent housing supply.
For those of us in the industry, it's important to see how CMHC's efforts could stabilize home prices and improve supply, leading to a more balanced market. It's something investors and homeowners alike should keep an eye on, especially when it comes to changes in borrowing costs and housing completions.
Absolutely, Janine. This move could reshape Canada's housing landscape by setting a new standard in housing policies. By moving towards sustainable growth and realistic benchmarks, we might see broader economic stability as well.
Steve, let's talk about the recent drop in insolvency filings in Ontario, which fell by 5.3% in April compared to last year. While on the surface this might seem like good news, experts are cautioning against seeing this as a sign of recovery. It appears that many homeowners are still under significant financial stress, especially those with mortgages.
That's right, Janine. The Office of the Superintendent of Bankruptcy reported this decline, but insolvency firm Hoyes Michaelos points out that their homeowners' bankruptcy index rose to 8.5% in May. This suggests that while filings dipped, the pressure on mortgage holders is intensifying due to high interest debt and housing costs.
It seems that many people are turning to consumer proposals to avoid bankruptcy, with such proposals making up 77.3% of all filings across Canada in April, and even higher at 80.6% in Ontario. This indicates that while people are trying to restructure their debts, they still need significant relief from overwhelming debt levels.
Exactly, Janine. The reliance on consumer credit is increasing, especially among younger borrowers and in regions with high mortgage costs. Equifax reported that 1.4 million consumers missed a credit payment in the first quarter, which is quite concerning. It shows that while insolvency filings have decreased, financial strain is still very present.
And it's not just about the mortgage payments themselves. Hoyes Michaelos noted that the average insolvent homeowner owes an additional $72,510 in unsecured debt on top of their mortgage. This compounding debt burden is what often leads to insolvency rather than the mortgage alone.
Yes, and those most vulnerable seem to be landlords with multiple properties and pre-construction buyers who are struggling due to falling property values, rising interest rates, and construction delays. These factors are making it harder for them to manage their mortgage payments.
Nationally, while the total number of insolvencies fell by 3.7% from March and was down 1.8% year over year, the trend still points to mounting pressure on households. Over the past year, consumer insolvencies have actually risen by 6.1%, with both bankruptcies and proposals trending upward.
Hoyes Michaelos suggests that the combination of rising interest rates, falling home prices, credit tightening, and increased unemployment are contributing to this trend. They predict consumer insolvencies will likely increase in the latter half of 2025 due to these persistent challenges. Let's shift gears to discuss the Canadian 10-year bond yield, which has recently climbed above 3.36%. This increase is largely due to several factors, including a rise in bond supply, ongoing inflationary pressures, and hawkish expectations for the Bank of Canada. It's a complex situation that has many implications for our economy and the real estate market.
Absolutely, Steve. The Government of Canada's borrowing plan for 2025 to 2026 is quite hefty, with a record 628 billion Canadian dollars in issuance. This is partly due to a delayed budget and a commitment to increase defense spending to 5% of the gross domestic product. Such a large borrowing plan increases the supply of bonds, which in turn puts pressure on bond prices and yields.
Right, Janine. Despite headline inflation sitting at a manageable 1.7%, core inflation measures like the Consumer Price Index TRIM and median are above the Bank of Canada's target band of 1 to 3%. This situation makes it less likely that we'll see interest rate cuts in the near future, keeping long-term yields elevated.
And let's not forget the recent drop in oil prices, which followed optimism around a Middle East ceasefire. While this is positive news on the geopolitical front, it has reduced export revenue for Canada, adding a fiscal risk premium to our economic outlook. This could make things more challenging for the government as they manage these various economic factors.
Indeed, Janine. Moreover, the economy is showing signs of stagnation with back-to-back 0.1% GDP contractions in April and May. This economic stagnation might eventually lead to monetary easing, which could help to stabilize or even lower the bond yields in the future. But for now, the elevated yields reflect the current economic uncertainties and challenges.
It's a delicate balance, Steve. While the high bond yields might present opportunities for some investors, they also signal caution for others, especially those involved in real estate and mortgages. It's crucial for us to monitor these developments closely as they have a direct impact on borrowing costs and the broader housing market.
Let's talk about the recent decision by the Office of the Superintendent of Financial Institutions, or OSFI, to keep the domestic stability buffer unchanged at 3.5% for Canada's largest banks. This decision is seen as a clear signal of confidence in the resilience of these financial institutions despite the ongoing geopolitical and economic tensions.
That's right, Steve. The buffer is essentially a capital requirement designed to protect banks from economic shocks, and keeping it stable suggests that OSFI believes our banks are well equipped to handle the current challenges. It's a reassuring move in light of trade conflicts, higher tariffs, and inflationary pressures.
Exactly, Janine. Superintendent Peter Routledge mentioned in a press briefing that conditions have been better than initially expected, which is a moderate comfort. However, he emphasized that OSFI remains focused on potential downside scenarios, which is why the buffer remains unchanged for now.
And it's worth noting, Steve, that Canadian banks are currently well capitalized. The average Common Equity Tier 1 ratio, a key measure of a bank's ability to absorb losses, is at 13.6%, which is slightly above the global median for systemically important banks. This suggests a strong position for our banks compared to their international counterparts.
Yes, Janine, the DSB acts as a resilience measure, and OSFI does not consider competitive issues when setting it. Instead, they focus on how stress scenarios could impact the bank's balance sheets. While the current CET1 requirement remains at 11.5%, some analysts like Paul Holden from CIBC believe it could be lowered in the future, especially if we observe regulatory changes in the United States.
Indeed, Steve. OSFI has expanded the allowable buffer range to 0 to 4% to offer more flexibility in response to changing conditions. They're closely monitoring risks like high household debt and deteriorating real estate values. It's a prudent approach given the unusual economic uncertainty we're facing.
Certainly, Janine. The decision affects major banks such as Royal Bank of Canada, Toronto Dominion Bank, Scotiabank, Bank of Montreal, CIBC, and National Bank of Canada. OSFI reviews and announces changes to the buffer level twice annually. So it's something we'll keep an eye on as the economic landscape evolves.
Absolutely, Steve. It's crucial for us to stay informed about these regulatory measures as they have a direct impact on the financial stability of our banking sector, which in turn affects the broader economy and housing market.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.